Hey guys, what's up? Are you curious about commercial financing? Well, this video is perfect for you. If you have a business now, you want to buy out your location, maybe you want to buy another location, you might want to take some notes because I'm going to go through all that. My name is Zevi Shafran. I'm the owner of a company called Loan Brook Inc. in Woodland Hills, California. We're a commercial financing shop. Now, we do specialize in all forms of commercial financing, anything from office, light industrial, multifamily, owner user, hospitality. It doesn't really matter what it is because the concept is very much the same. So let me walk you through it. And if you have any questions in the end of this video, you're gonna see my contact information or maybe in the description below. You can also drop me a comment and let me know what your question is. I'll be happy to answer it. And by the way, if you like the video, please give it a big thumbs up and subscribe to the channel. With that, let's dive right into it. You have a business right now and you're trying to qualify for a commercial loan. I want to take a couple steps back. What if you're starting a business and you want to buy out whatever office, warehouse, whatever it is you're trying to buy out? There's a couple different things that I want to walk you through it. Typically speaking, the lender wants to see that you've been in business for at least 2 to 3 years when you do in fact apply for commercial financing with your current business, okay? So the reason I say that is because if you just wanted to open a business and go open a warehouse or buy, an office space, whatever it is, they would actually look at the financials of your current business over the past 3 years. And if you're gonna maintain that business and carry it into the new space, that's fine. But if you're not doing that and you're starting a new business, then that would be a challenge because you have no financials to present, all right? So that's number one. Hopefully that makes sense, simply because the lender is looking to lend to a profitable company, meaning that the company cash flows. As an example, if I was to give you $1,000, right? For you to be able to get your money back, you would want to know that I make at least, say, $1,300 a month, because if I don't, then there's a likelihood that you're not going to get your money, because not only do I not make enough money, I don't make above and beyond enough money to be able to pay you and still live. That's the general concept in a nutshell, and I'll walk you through it. In the commercial space, in general, what happens is you have a lender that wants to cash flow 3 years of your current business, right? Now, they typically, unlike the residential world, right, they will typically get all your documents in line and do something called spreads. Spreads basically means that they looked at your business as a whole and they determine whether the business makes enough money for you to be able to support the new payment for whatever, building you're trying to buy. Again, we are going to be giving you a loan subject to a certain loan to value, right? So whatever the value is of this building, which is going to get appraised, and that's how the lender is going to know what the value is, they're going to give you a certain loan to value. The reason I don't necessarily want to go into the loan to value scenario, which basically only means how much money can I actually get, right? So as an example, I'm buying a building for $1 million. Can I finance the whole thing? Typically, it depends on the type of program that you're gonna go through. Now, I'm gonna cover as much as I can in this video. Like I said, if you have any specific questions, just drop them in the comments below or shoot me an email. This is what I wanna tell you about loan to value. If you go the route of Small Business Administration, SBA, similar to, then there's a reason why I'm comparing it, similar to FHA, Federal Housing Administration, when you're buying a residential home, you can get higher loan limits. However, with that, there's also a guarantee fee, which, if you have FHA, I believe it's 1 3/4, which goes into a pool of mortgage insurance. When you do SBA, it's 2 3/4% guarantee fee of the amount that you borrow. So if you go in that direction, you could potentially borrow as much as 90% of the value of the property. And as a matter of fact, you could also get working capital and potentially hit 100%. You still have to put in about 10% of your own money, but higher leverage is definitely possible. However, if you do have a down payment, then I personally would recommend to go the institutional route, the bank route. And the reason is simply because the cost of capital, the cost of the loan is going to be cheaper. You're going to end up paying less, and the upfront costs are going to be less. So that's a major milestone that you should know when you're shopping for financing, because typically speaking, everyone wants to go high leverage. Yeah, I'd like to finance 90%. Remember something, the more you finance, the higher the payment. Also, typically, the more you finance, the higher the interest rate. So it goes hand in hand. It's basically layered risk. The more risk you're telling the lender that you would like to propose, the higher the rate the lender is going to offer you. Does that make sense? Moving on. So now we have a loan, right? Financials over a period of 3 years. We want to make sure that the business cash flows, simply meaning, like I said before, that you make more money in your business than the proposed payment. Now, what happens if it's a wash? If you basically make the same amount of money as you do in your business, that's okay. However, globally, meaning that not only they're going to run, the guarantor's credit, which is the person who's applying to the loan, right? And you might say, yeah, but we have multiple guarantors here. We have about, 2 other partners. That's fine. Anyone who has more than 25% ownership in the business is going to have to present their financials, and therefore they're going to have to be accounted for when it comes down to guaranteeing the loan. Now, in some cases, that can be bypassed if you have a very strong guarantor who can actually carry the whole thing. There's a lot of caveats, and I don't want to get into underwriting pieces. However, for the most part, in commercial world, a lot of the loans are based off of cash flow, which is also called DSCR, debt coverage ratio. All right? And typically speaking, that concept is true as well when it comes down to multifamily and other products, which I'm not going to get to in this particular video. Now, after the lender is underwritten initially, not a full underwrite, just a glance, making sure that the spreads work, they're going to issue something called a term sheet. It's actually an LOI, letter of interest, letter of intent, whatever you want to call it, but it's going to outline the terms of the loan. And then at that point, they're going to issue it to you. And if you like the terms, you sign it, and then they start the process, right? Typically takes a lender a couple weeks to underwrite your financials, which are basically, the income, your debt. They will run your credit or the credit of the guarantors. Most loans are not going to be non-recourse, meaning that you're going to have to guarantee the loan. And even if you guarantee the loan, it doesn't necessarily mean it's going to pop up on your credit report. It only would pop up if there is a problem and you actually are not making payments. You could actually take title, and most people do, in the name of a limited liability company, which is a holding company separate from your company. And the reason a lot of people do that is simply for liability purposes, because you have your company here that you're vested in, and then over here you have a holding company, right? But you're the guarantor of the holding company and you own your company. So it all kind of makes sense. Now, mind you, I'm not an attorney, I'm not a CPA. So for any legal advice or tax advice, consult with legal professionals, your CPA, and your attorney. But I'm just telling you about the general concept of how most people, in fact, hold the title to, their properties. And that seems to be true across the board. Now, once the lender is finished underwriting your financials, what they'll do is they'll issue you a commitment. A commitment letter basically says, you know what? It's almost like a conditional approval for when you get a residential loan. It tells you you are actually approved, and then these are the conditions of the loan that we would like for you to satisfy for us to be able to fund this loan. In the commercial world, when that happens, typically you give a deposit to the lender, because what they're going to do is they're going to use your money to order third-party reports. They're not going to use their money, they're going to use your money, because anytime in the transaction, if you actually say, you know what, I don't want to do this, they didn't lose out, it was your money, and they, in most cases, will give you the rest of the money that hasn't been used. You go through the transaction, okay, meaning you get all the third-party reports. Third-party reports have to do with appraising the property to know exactly how much it's worth, right? Remember, we talked about that loan to value. Well, what is the value? Well, nobody knows unless you get it appraised, right? And then there's something called an environmental. And environmental is simply making sure that the ground that the building is on is not contaminated. So they run reports, right? And typically there's a scale, and if the scale gets redlined, then they go further and they go into something called a phase 2, and that could get expensive because they start testing air and soil and a bunch of different things. We're not gonna get into it in this video. Ultimately, in my opinion, it's actually easier, believe it or not, to get a commercial loan than it is a residential loan. There's so many moving pieces in a residential loan simply because they're underwriting to guidelines that is like a master puzzle. And the commercial world, I feel like it's a lot more logical. They base it a lot, more on the company's financials. And in some cases, and I'm just gonna throw this at you, if there isn't enough income in a company, they may get another company, meaning as an example, say I own 5 LLCs, right? And I have X amount of money in here that I make every year, and it's just not enough. So they may get another 2 of my LLCs to guarantee the loan simply for me to be able to secure financing, right? And some people will say, well, why do they do that? Well, because you don't show enough in one LLC. The 2 other companies that you have, they do show enough. There's more flexibility and things that you could do. The downside to a commercial loan is that in most cases, it's amortized over a shorter period of time. Unlike residential or multifamily, it's not 30, typically it's 25 years, which means that you pay off your payment sooner, which is great, but the payment is higher. It's also not fixed for 30 years, it's typically amortized. It could be amortized over 30 years, could be amortized over 20 years or 25 years, whatever it is, right? But the terms are typically shorter, like 3, 5, 7, 10, in some cases 15, not very typical. But, and as you go higher on the term, the interest rate also typically goes up, and so does the prepayment penalty. Mind you, nowadays, in owner-occupied properties, there is no prepayment penalty, only an investment in some programs, not conventional programs, but non-QM programs, portfolio programs, not what this video is about. But those exist in the commercial world, typically on every single loan. There's either a step down, a yield premium, or a swap. There's different prepays. There's only so much I can squeeze into this video, but I do want to answer all of your questions. So if you are in the market shopping for a commercial property, or you have questions about securing financing for a commercial property, in the description below, you'll find all my contact information. I will be happy to discuss it with you. I thank you so much for watching. Again, if you like the video, please give it a big thumbs up. Subscribe to my channel. I'll catch you in the next video, and I look forward to working with you.